Understanding the General Anti-Abuse Rule, GAR, in corporate tax law. Corporate tax laws often include safeguards to prevent taxpayers from engaging in abusive transactions or arrangements, legal structures or strategies that exploit loopholes in the law to achieve tax benefits unintended by lawmakers. Such arrangements, while technically compliant with the letter of the law, may be inconsistent with its underlying purpose or spirit. To address this, many tax jurisdictions, including the UAE, apply a General Anti-Abuse Rule, GAR, designed to counteract these strategies and ensure that tax benefits align with the true intentions of the corporate tax framework. 1. Purpose of the General Anti-Abuse Rule. The GAR exists to prevent the misuse of tax laws by taxpayers who create or participate in transactions solely for the purpose of gaining tax advantages that the law does not intend to provide. Specifically, the GAR serves as a countermeasure to arrangements that may appear lawful but contravene the intended objectives of the tax legislation. It is focused on transactions or arrangements designed primarily to achieve tax savings, rather than pursuing a legitimate commercial purpose. By establishing a framework to counteract such strategies, the GAR helps maintain the integrity of the tax system, ensuring that tax obligations reflect the true economic substance of transactions rather than artificial arrangements. 2. Role of the Federal Tax Authority, FTA, under the GAR. The Federal Tax Authority, FTA, is empowered under the GAR to review and counteract corporate tax benefits that arise from arrangements deemed abusive. This authority allows the FTA to adjust or nullify tax advantages if it determines that a transaction does not align with the law's spirit and purpose. The FTA's role under the GAR includes identifying abusive transactions. The FTA examines transactions and arrangements to identify any that appear to lack legitimate commercial reasoning and whose primary purpose is tax avoidance. Counteracting tax benefits. If a transaction or arrangement is deemed abusive, the FTA can adjust the taxpayer's tax position to remove or reduce the inappropriate tax benefit, ensuring that only genuine, economically justified transactions receive tax advantages. Applying the abuse test. The FTA uses a structured test of abuse to evaluate the nature and intent of the arrangement, considering both commercial validity and alignment with the law's intention. 3. The GAR Abuse Test. The abuse test is a critical component of the GAR, guiding the FTA in determining whether a transaction or arrangement qualifies as abusive. To apply this test, the FTA considers all relevant circumstances. The FTA examines the full context of the transaction, including economic, business, and commercial factors. Commercial reasoning. The transaction must have a genuine commercial purpose beyond simply achieving a tax benefit. Transactions that serve no substantial commercial function, apart from reducing tax liabilities, are at high risk of being classified as abusive. Primary purpose of the arrangement. The FTA evaluates whether the main goal of the arrangement was to gain a corporate tax advantage that contradicts the spirit of the corporate tax law. This involves a close analysis to determine if the arrangement would likely not have occurred in the same form without the tax benefit incentive. In simpler terms, if the FTA can reasonably conclude that the main objective behind a particular arrangement was to secure a corporate tax advantage contrary to the intent of the law, the GAR allows them to deny or adjust that tax benefit. 4 examples of transactions that may be subject to GAR. The GAR may apply to a wide range of scenarios, such as artificially complex structures. When a business adopts overly complex organizational or financial structures, the sole purpose of which is to minimize tax, without serving any legitimate business need. Circular transactions. Transactions that result in a return to the original state but yield tax benefits due to the appearance of a new structure. Loss generation. Arrangements aimed at artificially creating losses that the taxpayer can then use to offset other taxable income. In each of these cases, the FTA would consider whether the arrangement serves a genuine economic purpose or is primarily intended to exploit corporate tax law. 5. Effect of GAR on corporate tax compliance. The GAR serves as a deterrent to aggressive tax planning, encouraging businesses to engage in transparent and commercially justified transactions. By enforcing the GAR, the FTA ensures that corporate tax compliance aligns with the economic reality of a business's operations. Only transactions with a genuine commercial rationale benefit from tax advantages, promoting fairness and consistency within the tax system. Businesses are discouraged from using tax avoidance schemes, as the GAR increases the risk of penalties for those who prioritize tax benefits over genuine commercial needs. For more details, contact us.